Hey everyone, Meet Kevin. Welcome back to another Meet Kevin show. We've got rocket emoji mugs, rocket emoji shirts, because we are talking to the rocket of finance here. We've got Ross Gerber coming on again. So many of you have been so excited to have Ross come back because, wow, Ross blew our minds the last time we talked about options and Robinhood. And Ross, I gotta actually bring you on here, and I'm so excited to start off. But let me let you introduce yourself quickly, and then I've got a million questions for you.
Introduce myself. I'm Ross Gerber. I'm a financial advisor. I manage about $1.8 billion in money for over 7,500 clients across the United States and now across the world. And we just actually launched or launching this week. We're the first RIA to be launching a digital asset program to begin selling Bitcoin to our clients. So that's been in the news all week, and we're excited about that. So that's what we do. We help people build their financial plan and make smart investments for themselves so they ultimately can achieve financial independence. And the best part is we have no minimum, so we work with everybody. So that's Gerber Kawasaki, and that's me.
That's amazing. So last time we spoke, we touched on Robinhood, and
Right.
you were not very excited about Robinhood and options. And when we last spoke, I believe it was, I should look at the date, but I believe it was right before the market kind of started selling off. We've had a pretty volatile last, month basically here. How have you guys been doing? How have you guys been holding up? How do you feel for the Robinhood option folks who maybe got hurt a little bit here over the past a bit? How are you feeling?
Well, I mean, I think it's exactly what we were kind of talking about and what I was saying about the risk levels of options, where, when you're betting on stocks in either direction with options, you have so much, little room for error that when markets correct, you get wiped out and you lose 100% usually on these options. And corrections sometimes can last for a few months, and therefore you can get wiped out of even 1 month, 2 month, 3 month options as well. So it's very costly when you have leverage and then the market's correct. So for us, we avoid leverage at my firm. So if the market, like the S&P, is down 3% from the high, that doesn't mean anything to us. You know what I mean? Like, so for us, we like the volatility. So this is how I make money. So I really look forward to the days when everybody's selling stocks. So I like it right now.
Wow. Yeah. In fact, I'm pretty sure you mentioned selling Tesla, and you sold Tesla stock. I think you mentioned somewhere around that like 80, something like that, pretty much almost peak pricing there. And Tesla's had a little bit of a bloody ride just even the last, since we spoke the last 3 weeks here. And I saw you mention on Twitter that you bought back in. Tell me what happened.
Well, no, we never sell our Tesla position like as a whole. When I say I sell some Tesla, it's because, like prices get to a point where I think they're very high, and then that becomes such a large part of our portfolio that then we take some profit off. So it's really more like adjustments. But, the way I look at it is I don't want one company driving 100% of my returns, because if that company does stumble, then you've got a problem. It's kind of like having the best quarterback in the league, but nobody else on the team is good. So you might get to the Super Bowl, but if your quarterback gets hurt, you're done. It's like, so I got to have some other players on the team, and Tesla's still our number one player. So we took a little bit of profits at 850, and then when it broke below 600, for the long-term investor, that gets to be interesting to me. So we bought some back, and we're not really traders. So it's not like I mean to do that. We just think Tesla at 1,000 is kind of expensive, and Tesla at 500 is a super buy. So if it goes closer to the 1,000, we might take a little, chips off the table and get that rebalance. And if it goes down below 600, then we'll add, and this is kind of how ARK trades as well, so that our position kind of maintains the same size in the portfolio.
Yeah, which makes me curious, your thoughts on, Kathy Wood's new Tesla
Yeah.
numbers. $3,000 price target 2025. That's in her base case. In her bull case, she's got 10 million vehicles delivered and $360+ billion in robotaxi pricing or
Right.
income. And we're like, wait a minute, we don't even have robotaxis yet. How do you estimate $1/3 trillion of robotaxi income?
Well, yeah, and that's the best case. I mean, you know, so you got to read the way they do things because it's super smart. So this is not like an arbitrary system they're using, you know, as much as the numbers oftentimes seem outrageous, which any normal person would think that.
Yeah.
There's math behind these numbers. So when you read through the sort of justification for it, I think the bull case is absurd, but you know, obviously anything's possible. I think the base case is reasonable. And the base case assumes still a substantial amount of robotaxi revenue. I think it's at something like 40 billion in 2025, and that's 4 years from now. So it's a long enough period of time where it's still hard enough to really determine what's really going to happen, but it's a short enough period of time that we kind of know what Tesla's going to do over the next 2 to 3 years, pretty sure. So the question to me is robotaxi a reality as a functioning business without other drivers in the next 4 years? And I just don't think that's a reality. So the way I model Tesla is I take it out. I just put it to zero. So if I put it to zero, then it's all upside if it happens. You see what I'm saying?
Yeah.
So I did this with Kathy's last estimate. This was years ago. And of course, her numbers ended up working out. But Tesla was also extremely expensive as a stock in that scenario. And so I think that if you work that back, in the way I did the math, I got to about $1,000 a share today. So based off their numbers, they think Tesla should be worth about $1,000 a share today. And that's my best case scenario for Tesla over, let's say, the next 2 years. Okay, so if I can buy Tesla at 600 and it goes to 1,000 in the next 2 years, I've made a very good return. Okay, so that's like, you know, 65%, let's say. So I think thinking that Tesla is going to be 1,000% stock again is kind of silly, but like, can it be a 20, 30, 40% gainer for the long term? For sure. And I think that's just depending on what price you pay for Tesla. So I think their assumptions are great, and I think it's a great base. And from there, you can get to a good number for Tesla. And if you take out Robo, it works within my numbers, and I'm good with them.
Now, are you, so you're taking out robotaxi. Are you also doing the Kathy where she's taking out energy? I mean, she's got zero for energy. Solar,
yeah, so the problem
batteries.
with that, right. So the problem with that is cells. And so look at it this way, okay? Like,
yeah,
the genesis of all electric vehicles or storage is the battery cell. The battery cell is made by 3 people other than Tesla in the world, okay? There is now, every company in the world wants to build electric vehicles or build electric storage, let's say. So Elon says this very clearly. The biggest issue moving forward is the amount of cells that can be made with the capacity that exists today. And with what that is, it's maxed. So Tesla has 2 gigafactories on track to open at the end of this year, which will basically double the production of battery cells. Plus, they have new cells, which are 7 times more efficient. This is huge. But Tesla isn't going to give away any of the other cells that they use for cars either. So even though Tesla's increasing capacity, they're not decreasing their use of other cells. So who's going to fill the void? Well, there's a lack of capacity. So every cell company, this is where we're investing a ton of money right now. Every cell company is increasing capacity as fast as possible. Last week, Volkswagen said they're going to make gigafactories, which is kind of funny because Tesla is the gigafactory. I don't know how they make a gigafactory because they don't even have the technology. But what they're saying is we need to build cell factories. So storage, there's no room for storage. There's no ability to scale storage. So if cars are going to be replaced, every cell is going to be used. So it's very hard to model for something you won't have capacity for.
Wow. Okay. So you really think, I mean, this is all constraint driven. Like, hey, if we didn't have a shortage of batteries, we're just ramping up everything at the same time. I mean, isn't that a reason to be very bullish on just the next even 20, 30 years of really Tesla?
Oh, I mean, once again, it's my biggest investment. I don't know, what do we got? 80 to 100 million in this stock. And, honestly, if you can stomach the volatility when you wake up in 10 years, I don't see how you're not substantially better off by Tesla. Granted, there's risk, but the reward could, it's Apple. I think you said this. I think I was watching one of your videos where you were saying like, you rode the Apple train or something for a long time. And I was like, dude, same with me. I've been riding this Apple train my whole life. My whole life I've ridden the Apple train. There was a 10-year departure when they got rid of Steve Jobs. I think it was like 93 to 2003. I think that was the bad period for Apple. But we really invested heavily in Apple in 2003. And I was a professional investor at the time. And that was when the iPod Nano came out. And I've been riding that pony to this day. And I'm going to ride the Tesla pony for the rest of my career. So when we're old, you're a lot younger than me. So you'll probably most likely see more suns rise and fall than me. And I think if let's say you're 30, which I think you're even younger, but let's say you're 30, you think about living to 80 or 90, maybe 100, and where is energy and Tesla going to be? Like, that's how you have to think as an investor. And if you think like that, you'd be like insane not to invest in Tesla.
But so why, if you're 80 to 100 Tesla in mils for your company out of 1.8, you're like what, 5-6%, something like that. It doesn't seem like the largest pony. What's going on?
Oh, well, remember, our money's segmented into different groups. So if you have a small account with us, let's say $10,000 or $20,000, the chances of us owning Tesla individually as a stock are very low because we need to have diversification. So we use ETFs, companies like ARK, or Tesla's now a big position in LIT, which is my absolute favorite ETF right now because it's lithium and battery technology. Tesla's a top holding in there, so you get a nice allocation of Tesla in there, plus all the other investments I super love. So that's a way we get clients exposure to Tesla, even though they might not own the stock. Also in XLY, consumer discretionary, Tesla, I think is the second largest holding, but behind Amazon. And that's a nice little portfolio and a way to play Tesla. So we'll add Tesla through the indexes now because they're in the indexes. And so if you have a small account, we have to be diversified. So we add Tesla through these funds. So you don't actually see that. So it's hard to really assess how much Tesla we really own within the investments we own other than the individual stock. Now, once, let's say, you get to 250,000, 500,000 in assets, we start putting in individual stocks like Tesla and Apple, or NVIDIA, like our core growth stocks where we feel clients will get the best risk return allocation based off what they already have as their core base portfolio. So stocks are kind of like, the peppers on your pizza or whatever, it's like, so we build the pizza first and then we add the toppings, and the toppings are your stocks. And so if you don't really have any pizza, we got to start with building the pizza, and that's just dough and cheese. And it's just not that sexy, but you got to do it. You got to have a good solid base, right? And then as you build your wealth, that's when we can really look at individual issue stocks, because we want to own enough that we have diversification, and we want to give opportunities. Oh, I like casinos. Oh, I like pet food. Oh, I love Tesla. So that's where so many of our clients do own Tesla directly in small amounts, but those medium portfolios. And then for our high net worth clients, they might have a position in Tesla. For many of them have a 10% position in Tesla right now. So that's as much as I really want to go. Now, there's a thought process which you have and many other people have about being highly concentrated in stocks like Tesla. And for sure, that is a way to build wealth quicker and also have a few more heart attacks. But I don't have a fault. No, I mean, listen, I don't have a fault with people doing that with their own money. But when you're in the business that I'm in, you go out of business if you lose people's money. Okay, so I'm on 27 years. So my goal every year isn't to make maximum return for the client. My goal every year is to make the client happy. And what makes that client happy is me managing money to what their risk level is. Now, I literally had clients that said, we've made like millions in Tesla. Please sell half of it. I'm 70 years old. Okay. And it's like,
okay, makes sense.
You know what I'm saying? It's like, I can't be like, sorry, Grandpa. Tesla's, you're going to live to 90 and you'll be pissed at me, And no, I gotta sell half, and I gotta be a responsible fiduciary to my clients. So each client has a different objective. People build a lot of wealth when they're young, and I think if you're 28 and you have 25% of your portfolio in Tesla, although I think that's high risk, I think if you can stomach it, maybe that works out real well for you. So I'm not going to say not to, but I can tell you when the market turns, which it does, you will eat crap for 2 years. And if you're not comfortable with, if you wear your net worth on your sleeve, you're not going to make it. You're not going to make it. I know you guys count your net worth way too often, like all of you guys.
In other words, like look at your portfolio every day.
The
fluctuations.
Like think about it. Like I have clients that like never cared, and now everybody cares about the stock market. They start looking at their portfolio, and then they text me about stuff, and I'm like, why are you texting me? You haven't texted me in like a decade and a half. It's like, oh, I finally figured out I could look at my portfolio online. And I was like, bad idea, like, let's look once a month. You were happier before that, like, see, I try to explain to people, you don't make or lose money every day. In fact, that is an arbitrary number, what your portfolio value is every day, So it moves every day.
Yeah, the fluctuations are definitely there, and they can be stressful for people. I mean, I think the worst thing.
You want to know how much money I lose on days that are down? Like on a down day,
sure, let's hear it.
Yeah, like on a down day this week, I'll lose 20 million in a day.
Oh,
yeah. I'll lose 20 million. No, that's bad Wednesday. Geez. That's a bad Wednesday. Thursday, I come back, I make 15 mil back. Friday, I made 3 million back. And by the end of the week, it was like a net zero. So if I sat there and I just cried every time I lost 20 million each day, I wouldn't be in this business. So it doesn't affect me.
Yeah, I mean, I think there are a lot of folks that they compare their portfolio to their income, and so they see their portfolio, go down, let's say 20 grand, and they're like, oh my gosh, I have to work 3-4 months for that, and then they panic and sell at the worst possible time to realize those losses, just because they got to stop the pain because their back's up against the wall, and fight or flight. Well, you can't fight stocks, so just flee and sell.
It's so easy to sell. That's why real estate has certain advantages in a way where like you can't just
wait.
Sell
did you just say real estate has advantages?
Certain advantages, because you can't just sell it. So if you get, and you don't really value your real estate daily. Like I doubt that you go onto Zillow. Do you go onto Zillow every day? And because I know you have like 25 properties. Okay, so you go onto Zillow every day. You add them all up, and you're like, "Fuck, I lost 20 grand today." It's like, no, you don't do that. So that's kind of an advantage because mentally. So the other mental advantage that real estate has is people are like, oh, I can knock on the walls. I know it's here. It's substantial. And I'm like, Disneyland's pretty substantial too, but it's like people feel a greater sense of safety that there's a physical structure there, even though it can burn down or many other things can go wrong with it, but they can feel it. And so I think they'll hold those investments longer and they do better. And we've seen that, especially with primary residences. Like, people essentially invest in their own home and they live there, and it's one of their best investments because they can't really sell it. They're forced to save money, and over time they improve it because they live there. And then in the end, it actually becomes their most valuable asset. They never sold it. They're not going to sell it because they live there. So if people looked at their stocks that way, like I own Tesla, but it's my house and I'm never going to sell it. So I got, 200 grand in Tesla, and it doesn't really matter because I'm never going to sell it. And then I don't price it every day and I don't even care. And all that matters is that Tesla executes the business plan.
Yeah. It's funny because people will it's so funny. If I go to a listing presentation as an agent and, a client has the impression that their house, let's say in a $600,000 neighborhood is worth $750. Let's just say, which this happens, right? It's like, maybe we could try $699. Like anytime you come in with a lower number, the seller's instantly is like, oh, all right, we're done here.
This is why I hate real estate. This is why I hate it, because people don't understand the market, right? Like, so you go in and you say, like, the house is worth $650, and they're like, no, I want $700. You're like, no, the house is worth $650, and I want $700. I won't sell it. But then you're not selling it. Okay, because nobody's going to buy it. So it sits. It sits and it
But
sits
it's the
and it sits.
opposite in stocks. And in stocks, people are like, oh my gosh, my Tesla went down, from 800 to 650. I feel like crap. I'm an idiot. Like the psychology is
right. But but Mr. Market's a schizophrenic, like one day he loves you and one day he hates you, and you're like, what did I do this week? Oh, tech stocks were great on Monday and interest rates went up 5 basis points and now they suck and then sell them all. But people don't understand that these are computers. These are not people making decisions. These are computers that are simply an algorithm. It's the simplest algorithm. Like people who are like, oh, these algo traders and they're so smart. And I'm like, no, they're humans who just simply put in relationships between financial assets that then automatically adjust based off these changes in relationships. So rates go higher and we adjust by selling high PE stocks. Like Tesla didn't go down because somebody woke up and said Tesla sucks today. Okay, it went down because some computer was like, this is a high PE stock we own in the S&P. Rates go up, sell the liquid highest PE stock in the S&P. Nobody decided it was Tesla. Okay, it's just it was Tesla. So the fact that you can buy it at 600 instead of 850 is just a byproduct of stupid computers, and it's an opportunity.
Now, do you think that I trying to decide here. Do you think that with these interest rates and these fluctuations, that most retail buyers don't realize that a lot of this is, like you're saying, driven by these computers? And when they make investments into what they think are great companies and they see these fluctuations down, that they don't have someone like you telling them, no, like it's just the computers. They're thinking that's it. The world's turned on me. Everybody now hates this. And then that's what's leading them to sell out. Is that kind of what you're saying?
Yeah, it's all emotion. So behavioral finance has become a real popular topic, and I believe in behavioral finance. I say it all the time. I just put out a video about Dave Portnoy about behavioral finance because I find his trading to be hysterical to watch because, he's essentially an emotional being, like a super emotional betting guy. I mean, watch him in March Madness, and then he's trying to trade stocks. So every day there's a fluctuation. He's like all over the place. And I'm like, dude, this is not the way you do this because, you're going to go crazy. And so, the ups and downs of the market are a part of it. And so what's most important is understanding what's happening. What is happening? Is this a good time in America or is this a really bad time in America? Okay. Yeah. Because if you think the future is going to be good, then interest rates are going to go higher. That's a byproduct of things going good. Okay. But it also means earnings are going to go higher. And that's a great byproduct of getting higher stock prices. So if you really want Tesla to go up, earnings need to go up. That's all that matters.
Right.
It's all that matters. And so do you want a bad economy where people aren't buying cars, or do you want a good economy where people are buying cars? Now, I was just out testing the Ford, and it's busier in LA than I've seen it in a year. And it makes me want to cry in happiness to see stores open and people out and everybody's wearing their mask and everybody's cool. But life is like coming back. And I'm sitting here going, the restaurants are hiring, the retail is hiring, like the real estate's going to come back. People are going to go back to offices. Like life is going to change a little bit because we've have way cooler technology, but we're going to go back to going out on Friday night and maybe going to the movies and concerts again. And this is hugely, hugely bullish. So anybody who doesn't invest in the stock market today is missing out on one of the greatest potential runs that we'll see in a long time. Maybe 20,
so
30
you're
years.
Less concerned about like inflation, big inflation coming. We'll have volatility to get in is your thing.
There's no inflation. Okay. If I hear it again this week, I'm going to punch like some old economist or something. No, like, okay, look. In 1975, there was inflation. Okay. Let's go back. Okay. I don't know how old you were in 1975, but maybe it was negative 12 or something. But when I was a little kid, and when I was a little kid, there was oil embargo. So the Iranians got up in the morning and said, F you, America, we're not selling you any oil. Zero. Now imagine what that would do to oil prices, right? Goes to $150 a share. Our economy dies. Prices for everything soar. Okay? So this is the 70s. The economy dies. Prices go up. It was called stagflation. Nightmare. Carter was president. He was clueless. We were just getting off the gold standard. So in the Vietnam War, we spent, way more money than we had, and we borrowed lots of it. That was the first time we really went into debt as America, was actually during the Vietnam War. Wars have been the most costly cause of debt in the United States up until COVID, forever. So it was really our biggest cost. So when you think about Vietnam, then the Christmas bombing, 72, and then Nixon goes into Watergate and takes us off the gold standard, that was a low, that was a low. And inflation soars, right? So in 1983, Volcker comes in and Reagan, and they're like, this economy sucks. So we just got to kill the baby to save it, raise rates to 20%. You could buy a US government bond, 15%. The economy died for a year, and inflation was dead. From that point, 1984 to the present, the yield has only gone down. It's only gone down. Okay, so guys who bought real estate, guys who bought bonds, guys who bought stocks from 1984 to the present have made money, because the value of assets have gone up and the value of the dollar has gone down. Okay, it's really simple. So where's the inflation? Hasn't been there since 1983. Okay, now why? Well, one of the biggest reasons is technology. So what also happened in 1971 was Intel invented a computer chip. And when that happened, it's led to the greatest innovation cycle in modern man or woman. When in history have we ever invented more efficient, amazing things than since the computer chip? So that's morphed into the internet, which morphed into social media, search, GPS. Think about biotechnology, gene editing now. It's unbelievable, right? It's unbelievable. So the only thing people have to worry about is costs are being constantly forced down. And that's what we've been fighting for the last 20 years, is deflation. We don't need oil anymore.
I'm going to play the devil's advocate here, because pretty much everybody on the channel knows I agree. I don't believe there's this big inflation coming, but we can't deny the fact that there's been massive asset price inflation. Lumber's way up, groceries are way up, used cars are up, housing. You look around and it's just up. Now, Jerome Powell wants us to believe this is just temporary, right? Let supply chains normalize and this all goes away. It's all going to be okay. What if it's not? What if all this money printing catches up?
Now, that's a great point, and one that has value. So I think we could spend many hours trying to ponder what the outcome is for printing trillions more than we make, which is by far the largest amount in American history in the last 2 years. And it's not just a little above the record. You know what I mean? Yeah. It's like 5 times the record. Up, man. You know what I mean? Yeah. So what are the consequences of people paying $250,000 for a digital video clip? And I'm trying to, so every time in my life, every time I've seen this, there were issues. So I spent time thinking about this the other night. How does this go bad? Because I have seen this 2 times. I saw it in the 90s with stocks, and it wasn't driven by the same forces, but the same level of craziness. And then I saw it in the 2000s with real estate. Before the financial crisis, where people were flipping homes, and you would have gone nuts in this era. Boy, it was but then guys like you guys just got wiped out. I was going to give you some advice that I learned in the financial crisis. Yeah, well, I was going to give you. Well, no, you could say not like you, but it was like every shoe dropped and then another shoe dropped. So I know you're a successful guy, and I give you lots of credit, but there was stuff like that you just couldn't predict happening. You know what I mean? Sometimes you can just get whacked in ways you just can't predict. Like this guy, Gabe Hoffman, or whatever his name is at Melvin Capital. Who's going to buy GameStop and kill my hedge fund? Who would ever predict that, right? And it happens. And I'm sure the guy made $850 million last year in fees. $850 million. Yeah, trust me, this guy knows what he's doing, right? But yet stuff whacked him. It can whack you. It can whack me. Okay, so the first rule, George Soros, theory of fallibility is, Everybody can get whacked, and you better figure out where your vulnerability is, and it's usually leverage with real estate. So I'd say you should cut your leverage to 25%. You should cut your leverage to 25%. Because I was going to tell you this.
Real estate?
Yeah, in real estate. You know who becomes a legend in real estate? You know who becomes the legend? It's the one who has liquidity when the others don't.
Right.
That's where you want to be. So when this ends, you want to be the one with liquidity. You want to be the one with cash. And then you'll buy all these properties for nothing. For nothing. They'll give them to you. And then you wake up in 3 or 5 years and you'll be like, dude, I'm so glad Ross told me this. It saved my life. Because in times like this, things can reverse quickly over something we can't predict, like an Iranian attack or, a huge terrorist attack within the United States, like 9/11, or so many things that are, Russia, a solar sunspot blasting out all the internet. I don't know. Mm-hmm. Cut your leverage to 25%. That's the craziest times. Like these are the times you don't want to have leverage. I have no leverage. None. I use none.
Yeah.
None. I have cash.
I mean, there's huge value to what you're saying, because I look at right before this pandemic, I never refinanced my properties, and I would buy them below market value. Rarely, some of them I did, but very rarely would I refinance them. And when we went into this pandemic, and the Fed, it was like on a Sunday, they announced we're cutting rates to 0. I immediately called my lender. I'm like, refinance all of my properties right now. I need as much cash as I could get my hands on. And because the debt was very low on them, I all of a sudden, come like April 1st, had this boat of cash. And then I'm looking at the stock market going, thank you. It's just shopping
That's exactly
time.
the point.
So you're right.
That's exactly the point. And that's exactly what I mean. Exactly what I mean.
Yeah.
Where it was total panic in March.
Yeah.
Okay. And like during those times, because I don't have leverage and I had cash, I just hunker down, Yeah. And then because I have a lot of experience, I got to calm everybody, which is the hard part. But then because I know certain companies, I'm able to buy them. So what we did was we put like 10 million into the MGM hotels at like $10 a share. I think it closed to 41, and it's been a year. So I made like 20, 30 million just on that, and MGM I've known my whole life. We looked at the numbers. So we did buy real estate, the hotel, the Vegas casinos at it was like 50% of book value when we started buying MGM. And I know the company so well. So it was just a home run. I'm actually buying more at 40 just because now the online gambling part is even doing better than I thought. So we had the liquidity to make a few investments, and we buy a lot of corporate debt. When the Fed said they were going to back up corporate debt, a lot of it was trading at 14, 15, 16%. We bought a lot of that. That was what I learned in the financial crisis. When stuff is real tough and you're not sure what to do, you can buy a lot of debt cheap, but then you own these loans. And so if things go bad, at least you can take the assets of those companies and get money back. It's kind of the trade I'm doing right now with AMC. I'm buying AMC debt. I'm getting 18% now. I started getting 22% total return for a 3-year bond. They mature in 3 years.
Jeez.
You're
buying now, junk bonds, basically.
Junk is like a nice term for them. I call them shit bonds, but yeah, they're garbage. But if they're gonna,
junk
if you're gonna get listen, I got 11% yield, and I got a yield to maturity of 22%. So it's just got to stay in business. I get 22% a year. I'll take it all day long. So that's what we bought. And if you have liquidity when things go bad, you make a ton of money. If you're leveraged when things go bad, you lose everything. So in times like these, when things are really good and you're just killing it, it's not the time to increase your leverage. It's crazy.
Yeah.
It's the time to cut your leverage. So when things go bad,
I'll say,
you just sit.
Yeah. The biggest returns over the last year have been in those pain moments, right? In everybody's selling Tesla after the split in September, everything goes into crisis mode. We had a crisis mode briefly there in June. Obviously, March was like that's where you threw a dart and you're 4 or 5x. People say you can't time the market, but gosh, you invest in those pain times. That's when you're making money. I'm not making money buying Square in December at 230, you know, and now it's bobbing. Okay, it goes to 270, goes to 220, goes to 240, goes to 230. It's just bobbing.
Yeah.
You know?
Yeah. No, you're absolutely right. And I love Square, but I don't own it because it's not an opportunity. See, I don't get paid to just buy stocks. Okay.
Yeah.
Because anybody can just buy a stock. I get paid to deal with pain, you know, and that's what you're saying is true. Because what happens in March of last year, if I would have told people to go all in on stocks, they would have thrown stuff at me. You know what I mean? What was happening was I had my entire team on the phone for 24/7 for like a month, just trying to keep people from selling their stocks. You see what I'm saying? And we won't let them do it. And it's a nightmare. It's a nightmare. You don't understand how hard my job is. People want to sell. The world's coming to an end. Last March,
tell me about that.
We fought for toilet paper, you know?
Yeah,
and they're get me out. I can't get
so what are they saying? So they
get me out.
They're like, yo, okay, get me out. What do you say to them? How do you walk them off the cliff?
I say, listen. It's just a global pandemic. You know? We've done this, haven't we?
Oh, it's just a pandemic.
It's just a pandemic. Everybody's dying. Nothing to worry about. People fighting for toilet paper. Don't worry. You know why? It's a buying opportunity. And you know what? They literally would throw stuff at me. No, here's what we do. Firstly, the first thing you have to do is figure out how screwed up the government is, because they're ultimately the ones that backstop the system. Okay? So what we saw was incredibly scary. So what was happening was the system was broken. Our systems, nobody will ever admit it, and the financial system is held together with very few threads that are very delicate, and they work brilliantly most days. But when the stress gets too much, all of them break. Okay? So all these relationships don't work. Like LIBOR doesn't line up with the Fed funds rate, doesn't line up with what people will pay for a 2-year. And then all of a sudden it's mayhem in the markets. And with bond trading, there's humans involved. And so there's computer systems, and then there's humans, and then there's this how would I say it? So it's sort of like everybody looks and says, Fed, are you there for us? You know, it's like, are you going to be there for us? And so at that moment, Jerome Powell did the right thing. And he said, I will back everything. I will buy every bond. I will buy every corporate bond. I will buy back every debt in America. That's what Powell did. It's never been done. They called it during the financial crisis, it's called moral hazard. Moral hazard was probably the most discussed issue in the financial crisis, because we gave the banks $25 billion each, and we said, don't go out of business. Here's $25 billion, whether you like it or not. We own you. You'll pay us back, but you will take the capital and you will not go BK, and we will make rules so you will never do this again. Period. But they said, if we bail out Chase and Wells Fargo, now we've set a precedent that you can fail and we'll bail you out. It was called too big to fail. So now we create a system where everybody's too big to fail. Now everybody. So the idea was not to do that. The idea was, how do we make smaller banks so if one of them fails, it's okay and it doesn't really affect anything? It's kind of what's happening in China now, where she is like, no, you guys are too big and enough. You're going to screw us. Well, in America, the big just got bigger. Now you got 4 big banks, at least they're forced to be safe. But the moral hazard is now a reality, which is the Fed will not let anybody fail. So once we realized the Fed wasn't going to let anybody fail, my mistake last year, because I wasn't aggressive and we were lucky enough to make super high returns because our technology picks went through the roof, but we did not increase our allocation in any way. We played it super safe all year because I expected a much worse recession than we actually ended up getting. In fact, I misunderstood what was actually happening for months. And then UCLA helped explain it to me. The UCLA Anderson economists finally explained to me what was going on. And now I fully get what's going on, which is this pandemic's been wonderful for most people in the sense of business-wise. But for some people, it's been absolutely devastating and horrific. But it's only in 2 or 3 industries. And so that offset created huge positives too. Like we saved more money than we ever saved last year in American history because people didn't go out and spend it. Okay. So households are in the best financial position they've been in ever. So I wouldn't have predicted that a year ago, but that's the reality today. So the markets come back.
Yeah.
And you can't go BK.
Jeez.
You can't go BK. Nobody goes BK anymore. The Fed will save you.
Yeah, but I mean, it doesn't that exactly line up with the belief though that if the Fed's just going to save everyone, isn't the market just going to start pushing up the inflation narrative, and then it's going to become real because if we perceive it, it becomes real. As you know, the Fed sometimes says, like, hey, if we believe prices are going to go up, prices are going to go up. You know, the Fed likes to take the side of, oh, well, we don't think prices are going to go up because people don't believe prices are going to go up long term. But if you're saying, hey, everybody gets a bailout, in some sense, doesn't that lead to some lack of confidence eventually? Like when does that become too much?
Yeah, I think what you're saying is valid. So I spend a lot of time thinking. I think that's like part of my job. Like, so I'll like sit around and I'll be like, okay, all this money exists. Trillions exist. It's in people's, balance sheet somewhere, their bank accounts, their stock portfolios now, or real estate they're buying. All this money exists, tons of cash, just tons of cash. But people won't spend it. They don't really spend it. And I would think about the times when people really spent, really were spending money. And there's this optimism that happens. And I feel like that's what's going to happen over the next year. Because of the COVID ending, the optimism, the sense of freedom that comes with getting the vaccine. And, like my dad went out last night to dinner for the first time in a year with his friend. And he was like dressed up. And I was like, Dad, you're dressed up. The vaccine's making all the people partiers again. There's old people drinking, shots out the other day at lunch. I'm like, fuck, I need to get this vaccine. It's like party time, and that's what's happening because a lot of people have been cooped up for a year. And especially older people have been a lot more scared than younger people because it could kill them. And now they have the vaccine and now they're going out and they're spending money. And people are like, I'm ready to like spend money. Like I've saved enough money this year. You know what I mean? And so like, maybe we get some real spending. Maybe we get some good inflation. And then what happens next? Higher taxes on all of us. On all of us. Because the bill comes due. And the bill comes due. So you get growth in GDP, 6.5%, 7%, be the fastest I've ever seen America grow in my life. And other than like post 9/11 for briefly, but you get this really high GDP, and maybe that helps bring up tax revenue. Okay, it's helped offset the deficit. There's no more spending packages coming that are just pure spending. So any new spending is going to be offset by taxes. The people they're targeting for taxes are people who earn a lot of money, who have done very well during COVID, rightfully to be taxed more, as well as corporate taxes going up. Corporate taxes go up, earnings go down, stock market goes down. Okay, interest rates then go up. So you look at the yield curve, you got this curve. So interest rates go to 1%. 1% is where the interest rates need to be on once things get better, and that's in next year or whatever. So then interest rates go up. So next year we start dealing with higher taxes and higher short-term rates. And the minute that starts, that bump we got goes right back to where we were to the 2% growth. And that's what Powell is talking about, is that the fundamental deflationary pressures haven't gone away, and when we have to pay the bill, it kills growth. It kills it. So there's your inflation argument. We printed money, we gave it to them, they spent it. It's like cocaine, So we gave everybody cocaine. It was a great party. Next day, party's over. How do you feel? Shitty.
Gotcha.
And that's what happens when you do cocaine. You feel crappy. And that's what's going to happen in a year or two when taxes go up and the money's gone and the economy has to support itself and you have all these high asset prices. But then you start looking around and saying, where's the real growth? Are jobs really being created? Did we really create a better society out of this disaster? Or did we just figure out how to keep more people unemployed forever? And we've got these stupid ideas like just paying people to be unemployed forever. I don't know. So I'm not worried. Then the baby boomers get old and we have to pay for their health care, by the way. So The last thing I'm worried about is long-term inflation. I mean, my God.
Okay, hear you loud and clear there. So now I got to ask you this. Just a few minutes ago, you talked about making your clients happy. The ones who listened to you in March and didn't sell, because I'm sure there are some people who ended up getting through and they're like, no, I need it, whatever. The ones who stuck with you, I imagine they're happy. But how does that influence you when it comes to making choices now? Is it possible that if all of your clients are like, recovery stocks are the next big thing to invest in, Ross, I don't see enough recovery stocks on my portfolio. Is it possible that in a reverse way, your clients and the media could actually influence your investing decisions, which, I mean, in turn could go through the entire financial system?
No, it doesn't work that way. The tail doesn't wag the dog here. So when somebody signs up, they understand that we're guiding them. There's no reason to pay us otherwise. If they want to do it themselves, they shouldn't pay us. Okay, it doesn't make sense. It's a collaborative process, but we know what we're doing. You don't go to get, arm surgery and you're like, I've heard this technique is also really cool. You should try that, doc. And it's like, you really want me to try your technique, sir? Because quite frankly, you have no idea what you're talking about. Okay. So what we try to get out of our clients is many of our clients are experts in their industries. They know a lot about what they do. So what I do with my clients is I learn from them. I ask them about what's going on in their businesses. That's why I'm good at this. It's not about me guessing what stock is good or not by reading the Wall Street Journal. Okay. And I hate to tell anybody this, but you don't make money in the stock market reading Bloomberg. Okay. You make money in the stock market because you know what's happening. Okay. You know what's happening. Okay. Now, how do you know? Well, you got to talk to people and figure out what's happening. What's happening in technology? What's happening in the sports business? What's happening in the movie business? What's happening in video games? All the areas. What's happening in EVs? I went out and drove a Ford Mach-E today. I've driven the car. People go, oh, how do you know about this or that? Well, I just spent an hour going up and down the car, and I learned a lot about Ford. I know more about Ford than what Ford wants me to know right now. Okay. And I'm going to disclose it soon, maybe today, if you ask me. But I think the secret is, how do I work with my clients to get as much knowledge by working together from them about what they are an expert for, so that I can put all that together and make smart investment decisions, because we have access to so many smart clients and so many diverse clients. It gives us a wonderful insight into many industries. With that, we then form our investment opinions, and then we invest money for people. Okay. I would say 95% of our clients don't spend a lot of time looking at their portfolios. In fact, they're happy not to. So no, they're not calling saying, why don't I have more industrials, or why don't I have this or that? They don't care. Most clients care about the ultimate results, and they care about losing money. I'll tell you that, Kevin. If we're down, they care. Okay. But if they're doing well, and we've been beating the market the whole time, it's not like they're going to complain, So I think our clients understand our investment philosophies. We articulate them very clearly. We're on TV, we're on media, we put out tons of content so clients understand why we own Tesla. There's not a client that I work with out of the thousands that doesn't understand why we own Tesla or Apple or Microsoft. You see what I'm saying? And so it's like they're comfortable leaving things the way they are. Now, we have some clients who want a more active role, and they have their ideas, and we guide them. I'm their advisor. So I have some very wealthy clients who know a lot and do trade stocks, and they want my help. So what they're saying is, Russ, I want to buy Walmart. Is this a good idea? And I say, well, what's your premise? And they say, well, this is my premise. So I say, well, here's the good and the bad of Walmart. Here's what I think. Do you want to make this trade or not? And they go, okay, no. You know what I'm saying? And so it's like, working together, you have a better process. But I don't like when clients try to get me to do things that are against my opinion. But if they want to, they can. And I tell them, this isn't what I would do, but it's more money.
You said you didn't like John Deere, but you put money in John Deere. So where does that come in?
Well, so what happens is exactly what you're saying. So the markets are rotating right now, and it's normal. And with this rotation, cyclically sensitive stocks do well. And back in I think it was 2015, 16, we went through this period where all our tech stocks went down at the same time. There was nothing wrong. It was just bad luck. And it was we start getting these calls oh my God. And then it was Campbell's Soup was outperforming. It was the end of Obama and the economy got really slow because oil prices collapsed. And Campbell's Soup was rallying and all this shit. And so what happens is we underperform for a period of time. And the way people are, unfortunately, is that we can't underperform for periods of time because they are so short-term in their thinking. So even though over the long term, we've always outperformed, so we try to offset these periods of times when we see these rotations by buying stocks we normally don't buy because they help us. They create diversification. People are buying financials. They're buying John Deere. They're buying U-Haul. They're buying FCX, Freeport-McMoRan. I might even buy some Boeing next week. And that will be the 5 industrials or whatever you want to call them, commodities that we put in the portfolio. We shove that into the back, and then that gives us. So where do we take that money from is we're actually selling government securities to do that. So if I sell a bond that pays me 1%, I buy a bunch of dividend stocks at 2.5%. It's a great trade. It's been working ever since I started doing it.
Yeah. Well, this is interesting because it does set up, it kind of goes back to a little bit of the question I had that, if you can't outperform or if you can't underperform the market for multiple periods in a row, let's say multiple quarters in a row when people get their statements, because let's say you're heavy in tech, and then people are calling you going, hey, why aren't you outperforming anymore? And it's because you're still heavy in tech. Then even though maybe your clients aren't necessarily saying, hey, you got to be in these stocks you don't like, you kind of have to prevent underperforming during those periods of time where tech just isn't, which is normal. That's not your fault. That actually can set up these big long-term gains, right? So in some sense, is it possible then that the media is that's it, we're rotating to the John Deere and the recovery stocks, let's say, and then the people are okay, we're rotating. Then we start seeing that price action a bit, and now all of a sudden it cycles back to people like you, where it's well, crap, I can't be against the trend. I gotta put in Boeing.
Well, it's not. Look at it this way. I don't really care what the stock is to some degree, as long as it's going up. Look at it that way. If it was Boeing or Tesla, it's a bunch of letters and a price. Okay, and if the price is going higher and keeps going higher, I kind of want that one. Don't care what it is. You see what I'm saying? So my job isn't to swim against the tide all day. I don't know how much time you spend in the ocean swimming, but if you swim against the tide, you can be exhausted and go nowhere, literally nowhere. Okay.
Yep.
And you don't want to do that as an investor. So I've learned over the years that there's times when these stocks do well. It's an obvious trade to me selling something that I made 15% last year. So I made 15% of my government securities last year. Let's say it was a 10% allocation. There are a bunch of securities that now pay me 1%. Okay. And now I'm losing money every day on a government security. That started 6 months ago. Okay. So I can hold these government securities, but I've been doing this my whole life. What's the point of living a life in the stock market if you don't learn anything? So I've done these cycles 4 times, So you sell all the government securities is what we do, and that's why rates are going up. It's my fault, okay? It's not me, it's everybody, okay? It's an old trade. It's not we're geniuses here. You sell the 1% garbage because you know that you're going to lose probably 10 to 15% on those positions, and you rotate it somewhere where I can get a higher yield. That happens to be dividend stocks, yielding 2.5%. So I get 2.5% from JP Morgan and John Deere and U-Haul, that's a good return versus 1% in Treasury. Plus I get upside in earnings, and these stocks are going higher. It's just, and then every time tech goes down, these stocks are going up. And I'm this is perfect. This is what I want. It doesn't matter what the letters are. They're going up. This was going down. So I sold the one going down and I bought the one going up. That's what you're supposed to do in the stock.
Now, Kathy Wood has a little bit of a different approach, which
Yes.
might cost them a little bit.
Opposite approach. Yes.
Yeah, exactly. Speak to that a little bit, because look, in 2016, like you had mentioned, you're getting hammered in tech. She's like, yeah, we're getting hammered in tech. We're doubling down. That's kind of what they're doing now too. Like, they don't care about the recovery stocks.
They don't. That's their job, though. You have to understand, when you buy RK, you're buying the innovation fund. You're not buying the fund that's meant to get conservative when things go bad fund. You're buying the innovation fund. And innovation has huge volatility. So you get So I love it. I always say this. People love volatility up, but they don't like volatility down. It's like, it goes both ways. You can't make 120% in an index fund and then expect it not to go down 20 or 30%. It's just like the Tesla thing. People go, oh my God, Tesla's down 10% on the year. And I'm like, it's up 900% on the 2 years, and they're like, oh,
yeah,
I guess that's pretty good. Yeah, it's pretty good. I'm pretty happy with 900% over 2 years. Give up another 10% on Tesla. No problem. 800%. 800% in 2 years, Yeah. So, it's like the time frames matter. So it's the same idea. So with Kathy, and this is one of the reasons we don't have a lot of money with Kathy. We use ARC-F a lot because I like that portfolio, but she owns a lot of the same holdings as us. But then she also has so she's a pizza that's all toppings. So she's like a box of toppings. So it's like, it's every topping. And if you love toppings, you put ARC-F in your portfolio, it's the topping, it's got a place, but it is not the pizza. And they don't run pizza shops. They run a topping shop. And that's why they've done so well when things are good for them, is because when toppings are good, they're the best topping maker. But when toppings are bad, and you just want a cheese pizza, John Deere and JP Morgan, there's nowhere to hide at ARC. And that's why you use ARC to build your portfolio, not be your portfolio. You understand what I'm saying? It's like, you can't have just toppings on a pizza. I like pepperoni, and I'll eat pepperoni, and then you get a stomachache. That's what happens.
So, I think it's interesting because,
that's toppings.
Yeah, another thing that I noticed that happens a lot, and I can't seem to pull it up right now. But another thing that happens a lot is when the market's going down, you look at, here we go. I actually got it. Okay, here, let me pull this up. And I'm sure you've seen this kind of stuff. All right, so here we go. Okay, so this right here is a chart of inflows and outflows into RK. And if I just go to the last 6 months here, one of the oddities that I've noticed, is when the market's suffering, everyone's just taking their money out. You had 400 million of outflows here, 200 million, 150, 150.
That's
when the market's got, right. But these are people causing this, right? People are selling, dumping at the worst possible times. And then when the market's green, they're plowing $400 to $500 million in. Is this just people and their psychology problems?
Behavioral psychology. Look at this.
Yeah.
Okay. Everybody in America would be rich if they could do this right. Everybody would be rich. The stock market has gone up for 100 straight years. Okay. Pretty much, it's like stocks always go up. No, that's not always true, but over time it is true. And so if you were a young man in 1985 and you bought a bunch of stocks and you just invested in the stock market and now you're 65 or 70 or whatever, you'd be a multimillionaire. Doesn't matter how much money you made as long as you saved and invest. So why is it that so many people don't have money? 99% of people don't have $1 million to invest. So therefore they can't retire. So when you think about why that is, it's behavioral. So Vanguard has a study out there, and Fidelity Magellan did this study too. And what they did was they said, what was the actual experience of all of our clients over the time that the S&P 500 grew, let's say through the last 20 years? And what was the experience of the fund? And what was the experience of the actual investors in the fund? Okay. And what they found was a 4 to 5% difference in rate of return between investors and the actual fund performance. So if you just looked at every account that was opened and shut, and how much money it was made or lost, it was literally like a huge, huge difference from the return of the actual fund. And it was like, why? Well, people aren't good at this because of not a lack of intelligence, but a lack of ability to control their emotional relationship with money. Okay, so brings me to a story for this week. This week we get a Bitcoin lead. Okay, it's an old lady. She bought some Bitcoin 7-8 years ago. Old lady took $100. Somebody convinced her. Bought 50 Bitcoin, $2 a piece. Old lady never checked, never looked again. Thought it was a joke. Her kid comes up. Hey, Mom, Bitcoin's like 60 grand. Mom was like, what are you talking about? I got some Bitcoin. I bought some 8 years ago. Mom, you're kidding. You're kidding. Yeah, I haven't looked at it since. What did it do? 60,000. $3 million Mom has now from $100. So he calls us. He's like, please get to my mom now and sell some of this because we have no money. And now we figured out we have 3 million. Okay. Now, if she would have watched Bitcoin for the last 8 years, she might have sold it 10 times. But she just never thought about it, didn't care, didn't even look. That's how you make money investing. So if you're buying and selling, you're emotionally attached to the ups and downs, you will never make money in the stock market. It just doesn't matter. Doesn't matter.
Wow. That's a good hey man. Send her a diamond hand mugs right here.
Dude, you don't
diamond hand mugs.
I used to see this when I began my career. People would buy like AT&T stock and used to get the certificates. And like there'd be these old ladies when I was like 25 and I'd see these old ladies and they'd be like, oh, I have these certificates from AT&T. Well, it split like 10 times back in the day in the 80s. And so you'd have like SBC communication and this and that. And I'd get all these certificates and then I go back to the office. This is in the old days when you had pens and papers and stuff. And you'd like have to sign the back of all the certificates. So old lady signed on the back. We'll put them in a brokerage account, see what this is worth. Oh, it's worth $780,000. And she's like, I was just doing $20 a week or something. And I was like, yeah, you have $780,000 just sitting in your safety deposit box. You didn't even know, And it's like because they just invested the money, and it was a high quality investment, and they didn't overthink the up and down, And that's kind of what works. So if you buy ARK, the best way to buy ARK is on a monthly basis. So when it goes down, you're buying, and you don't think about it. So like ARK is a perfect what we call dollar cost averaging vehicle. Like Bitcoin, I dollar cost average into Bitcoin. I just buy a little each day or each week, each month, and I don't think about it, and I'm never going to sell it. If you just decide, so like I know some of the wealthiest real estate investors in LA, and 100% of them, if you ask them what's their secret, they say never sell.
That's what I say. That's great. I love that.
I know that's what you say. That's why I like you. I watch your stuff. I mean, if you were saying garbage to people, I wouldn't be on your show. I think you have a great show. I think you're trying to help people learn how to invest their money, and I think there's a lot of value, and you do it in a way that people like and learn from, and I think it's great. I think it's great what you're doing.
Well, thank you for that. This now brings me to I just randomly had this inspiration to ask you about what do you think about Ford these days?
Well, that was my day today. So
yes,
I've been having an interesting Ford experience this week. Some people, yes. I was in an article. They called me an EV evangelist this week in Forbes, and I kind of like that. I like that title. It's better than like wealth manager or something. And like I am an EV evangelist. Like I want to see electric vehicles take over, not only for my own profit, but also because I'm a big supporter of the climate. And I think it needs to be done. And so Ford comes out with a Mach-E, and I'm all for Ford coming out with an electric vehicle. I don't like when they come out with electric vehicles that are inferior to their gas vehicles just to try to placate people, but then really use it to sell gas vehicles. That was kind of what Audi did. So this Ford guy starts talking smack on Twitter about Tesla. And I'm like, I don't understand the wisdom of that, because I'm like, the Tesla community is like a gang. And you're part of that gang, and Tesla people and Tesla shareholders are super fervent believers in the cause and the company. And so if you're trying to promote your EV, attacking Tesla isn't the best way to do that, because the Tesla community can help you sell your EV, because we all know that nobody's going to be Tesla, and we want everybody to have EVs, including Ford. And so for me, if we're going to fix the climate, we need companies like Ford to go all EV, or else we're screwed, because they sell a ton of gas guzzlers, and that's their bread and butter. Okay, so this guy posts the other day that he has the Ford Mach-E and it's getting more miles than a Model X, and he's like, here's the proof that my Model X is a piece of crap and doesn't go as far. And I'm like, this is absurd, dude. I'm like, the Model X will just kill a Ford Mach-E, not to mention it's twice as expensive. So it's like weird you're comparing the two cars. You should at least compare it to a Model Y, which is the same price. But then I'm like, but the Teslas go farther. So I didn't really understand why this person, I wasn't sure if they're being paid by Ford. Now that they keep posting, I kind of think it's like the guy has some deal with Ford. We'll get to the bottom of that. So this guy, Mike Levine or Levin, is like the Ford head of sales of North America. Is like, Ross, why are you picking on our customer? And I was like, because he's posting bullshit. And like, no, I'm an internet watchdog. You post bullshit about Tesla, I debunk it. You know, like, I'm sorry. I've been doing this for 8 years. And I'm going to keep doing it for the rest of my life. Okay, I know more about Tesla than anybody. So if you're going to tell me that these cars don't go as far, it's a lie. End of story. So I go onto the Ford website. I'm like, I'm going to try this Mach-E. I want to see how many miles it really gets. Like, this guy says it gets so many miles. I'll go see it. So I go on the website. The website doesn't even list the Mach-E for sale. I go, oh, that's a problem. You got a car for sale. It's not even listed for sale. So you obviously don't want to sell it that bad. So I call the guy. He goes, I'll set you up for the test drive. And, oh, by the way, the car costs $60,000, but there's a $5,000 extra charge. So I post about this. I go, what do you mean a $5,000 extra charge? Oh, there's demand for the car, so we're just charging $5,000. Okay. So I post about this. I go, oh, this is absurd. $60,000 car, you're going to add $5,000. Nobody's going to buy it. I'm not going to pay $5,000 just to get a Mach-E extra on top of the $60,000. Like, I don't. And then they're like, oh, well, that's a dealer fee. That's not actually Ford's fee. I go, see, this is the problem. That the dealers are full of shit. And they have this antiquated model, just this antiquated business model that they have to get this margin, and Ford has to get this margin on the same car, and it doesn't work. Okay, so now I go today to pick up the car. Now this is even funnier. So I post about this $5,000 bullshit. So I go to pick up the car. This nice kid, he's 21. He doesn't know who I am, thank God. And so he's telling me everything. Right, great kid, and it's not bad stuff. But I'm like. So I get the car. I'm driving the car. Honestly, it's a great Ford. So like, I don't like Fords. Most Fords are really crappy, and like, this is a good Ford, and it was a good EV, and it was fast, and it was nice. It's a car. You see what I'm saying? It's not a Tesla, and I think driving it reinforced to me that Tesla is not a car company. You're not driving a car. You're driving a spaceship. It's a tech spaceship with wheels on it. Like, when you get in a Mach-E, you're driving a car. Like, it's a car. Like, it doesn't do anything but drive, and you're like, I can just drive in this thing. I can't do anything else.
Okay, hold on. You're losing me. I'm all for rocket ships here. I got a rocket ship on my coffee mug. Okay? But I gotta know, what was so bad about it that makes you say you're comparing rocket ships?
It wasn't bad. It's just like, I don't drive cars very often anymore. I drive Teslas. And so the speed, the handling,
I don't know what that means.
It's like a Tesla's like a Puma, on the road. You're just like, this is like you're driving a Ford, like I'm driving a Ford, and it's an electric Ford. But it's a good Ford, I'm like, I like the Ford, I would drive this if I drove a Ford, but I never have drove a Ford, and I never will. So I get back, and I was like, this is a good EV. I go, so what's the deal with the EV? He says, well, we have a lot of them on the lot. I said, I thought you said you were selling a lot of them. He's like, no, we're not. And I said, what? Why? Well, we had that $5,000 surcharge. But he's like, guess what? We had a meeting this morning, and they're taking the $5,000 surcharge off. And it's really weird. It was like out of nowhere. And I was like, oh, they must have seen my tweet. They literally, this guy Mike probably called the dealer and was like, you can't upsell these people because they're posting it on Twitter. Literally. I was like, oh, they probably saw my Twitter feed. He's like, I guess it was really weird. We had a meeting this morning. We can't rip people off $5,000. I go,
Would you test
why would you?
this?
Yeah, I test drive it. So I said, why would you charge?
Convince them to let you test drive it?
Because I'm a customer. What do you mean? Like, it's America. He doesn't know who I am. I'm not allowed to test drive a Ford. I test drive everything. I can sneak my way in anywhere. Like I got myself into the secret battery factory for Tesla. I could get into a Ford dealership. I mean, give me a little credit, No, so this is one of my secrets, man. I can befriend the people working places and they tell you stuff, and so basically, like, what's happened is Ford has a bunch of them on the lot. People didn't pick them up because it took them so long to get them. They're trying to upsell people. They basically, he said, like, people are paying the $5,000 because they don't know any better, and so, like, the dealer is basically ripping them off. And, like, I'm like, what kind of business model is this? So you want to compete against Tesla, where I can go onto an app and buy a car and be done, or I can go through this dealer bullshit that's been going on for the last 50 years, and it's still going. So it's like, here, it's a nice car and everything, but the way you buy something at Ford sucks. It's just the system. But now it's a dead system.
The way you were just demonstrating riding the Ford was like you were riding a John Deere. Are you sure it was that bad?
I would love to drive a tractor around for the day. I drove the FUV. I drove the fun electric vehicle from Arcimoto for a day, and that was super fun. That was like the funnest time I've driven around in a while. It's a nice car. If I was buying a Ford, I would buy a Ford EV. It's the only choice you have. So I'm on the lot. Then people are looking to buy these Broncos with 15 miles per gallon. They're selling the Broncos off the lot left and right. I'm like, dude, this sucks. You're selling Broncos. They're killing the environment. So this couple, I tried to sell this couple the Mach-E. I think I sold them one. And I was like, why would you want a gas car? You're killing the environment. And he's like, that's a good point. I was like, this car is Ford and it's electric. They can't even sell their own car. The guys in the lot are like, this guy's good. This guy's really good. I go, yeah, I'm good.
So, okay, so you test drove the Mach-E. You didn't love it. You're not going to buy Ford stock, I imagine. This is not like part of your rotation, right?
No.
Okay. Is bad. So Arcimoto, though, you do invest in. You test drove it for the first time. It sounds like it's a fun utility vehicle, the way they brand it. How are they going to get this freaking thing mainstream? They don't even have the mainstream factory yet. I know it's coming. They're working on it. But tell me about this. Is this going to go mainstream?
So like the FUV is a utility vehicle, so it has a place. It's not a car. It's not like meant to like, but if you look at the future and you think about all the different vehicles that will need to exist to serve different needs, this one serves several needs, from commercial uses to just entertainment uses to personal uses. But I think that's not the challenge with Arcimoto. Arcimoto reminds me of Tesla at the beginning when it IPO'd. They still need to build a factory and build the vehicle. So as much as I want to worry about demand, I'm not that worried about demand because I think the vehicle will sell itself. I'm worried about supply. The issue with building electric vehicles across the board is execution, and it almost killed Elon to build the Model 3, and he did it. So I think that's the big challenge for Arcimoto moving forward. And I think Mark, the CEO, is super capable. And I think because they've also brought in, some real experts, Monroe and Associates is involved with the manufacturing process. Yep. They're going in. So it's not a big investment for us. It's not like I'm going all in on the FUV, but we've made an investment. We probably will try to own at least like 1% of the company. And I think it's a good investment for the long term, but I think it's going to take a few years for this to play out. It's going to take a few years. Okay. So they've got a great product, but I think they have to execute. If they execute, you make 3-5x.
Sandy Monroe basically implied that he's under an NDA with Apple. Any thoughts on the Apple EV?
Yeah, so I'm close with some Fisker people too. A client of mine is on the board of Fisker, full disclosure. And I told her, I go, it's a piece of shit company. She's like, I'm on the board, blah, blah, blah. And I was like, listen, it's not my job to fluff you. I'm telling you the truth. I just don't think Fisker can deliver because everything's outsourced. So I think Fisker's trying to sell his car to Apple. And I think Fisker really wants to sell his car to Apple, and Apple doesn't want to buy anything because Tim Cook doesn't buy anything. I think Tim has spent billions hiring Elon's old guy to build an Apple car program for Apple, not really realizing that Elon's old guy can't build an Apple car program. And he couldn't build a Model 3 program either. So, Apple is the king, right behind Google, I would say, with investing in projects that will never come into fruition, including the Apple car or the Apple TV, for example, that never happened. So Apple is not an innovative company anymore. It's a company that has a monopoly that makes great products. It makes great laptops and phones. But I mean, the AirPods are a great innovation, I guess. They don't stay in my ear well, but I think that's the greatest innovation I can think Apple's had is the Apple Watch and the AirPods over the last 5 years. And they're nice products, but they're not going to change the world. And that's where Apple's at. So will a car come out that people will be driving with a big Apple logo on it? I mean, I just don't see that. Maybe it will.
Earlier, you touched on Dave Portnoy. Do you think his trading excitement hurts people?
Well, so you have to understand what Dave is. Dave is in comedy. He's in entertainment. He says it at the beginning of each of his shows. I'm not a financial advisor. You should not listen to me. You should not take my advice. And I think those are words of wisdom. Okay? But I think he's funny. And I think humor has a place in the stock market. And it's really refreshing because everybody's so stuffy, and you go on TV or you go on CNBC and it's stuffy. And then you got Dave comes around, throwing coffee and falling over, punching in the wrong trades, buying penny stocks because somebody tweets him, and it's hysterical. So the fact that it's gotten a lot of people interested in investing, it's a positive. It helps all of us. The negative is, I think he's in the gambling business and he makes investing into gambling because that's what he knows. But investing isn't gambling if you're smart. And I think that's a misperception that people oftentimes make, that the stock market is gambling when it absolutely is not. And you can gamble on anything and you can gamble on stocks, but people like me are not gamblers. And when I go to Vegas, I don't even like gambling that much. I gamble a little bit. It's kind of weird. I don't like to gamble that much because I don't like losing money stupidly on cards, let's say. I'll play poker, but blackjack, let's say, where it's luck. And I just don't like losing money that way versus just spending it, So I'll gamble a little bit, but I own the casino stocks. I'd rather own the house. So I'm not a big gambler. That's why I kind of take offense a little bit to making it a gambling game. But I'm a fan. I'm a Dave Portnoy fan. I love the pizza reviews. He got me to buy the stock. I'm up nicely on the stock. I still like the stock. I think he's a genius marketer, and I think I've learned a lot watching how he's marketed his business and built it. And Barstool has been really successful. So behind that goofball is a really smart guy, actually, and I think he's funny. He's the modern Howard Stern. That's what I think.
Okay. Last show, you were not very happy with it, and this aligns. You're consistent here. You don't like turning stocks into gambling. Last time we talked, you had some choice words for Robinhood.
They still in business? Are they still around?
What would you say if Robinhood say, hey, look, it said something like, our payment for order flow is no different than you charging management fees?
Well, it's very different. I think if I sign a paper and say, I'm going to pay you $1,000 to help me manage my money, you know what you're paying for. If I said, I don't charge you anything, I'm going to give you free advice, but a bunch of dudes who actually are the products I'm selling are paying me. So that actually used to exist in the mutual fund business. It was called soft dollars. And what would happen is if we did certain mutual fund companies, we would get money back. And so we would have this advantage to use, let's say, XYZ company versus this was back in the 90s. So in the 90s, I would get to go on a trip every month. It was insane. Like there was no rules about money and financial advice. So like every company would take you to Hawaii, go to Aspen, go to this. And like every month I was like, don't we work in this industry? You know, like I sell a few mutual funds for 2 weeks and then the mutual fund companies take me on trips. And in 1999, it was like that ended. There was like the laws changed. It was like, you're done. You can't do this anymore. And the last trip, they took us to Australia right before the millennial. And it was the most elaborate trip because this is like, you guys are going to have to remember this for the next 2 decades because we can't do this anymore, you know? And we go to Australia. Those were the good old days, right? So they ended those days because it created conflicts of interest. And it did.
Right.
Okay. It didn't necessarily with me because all the companies took us on trips, so I didn't care. But like, it's so easy to manipulate people through gifts and money. So there's so many rules as a fiduciary advisor about disclosures. You can go onto my website. There's a form ADV, and it goes over every single fee and charge. And then there's what we call the 2B of the ADV that I personally have that goes over every single conflict or every single business that I'm involved with that even could be considered a conflict. So it's all about disclosure to me. So my fee is no different than Robinhood's fee other than they lie about it. So they go out and advertise that it's free to trade. It's free, okay? But it's not free at all, okay? So that's the issue, not how we collect fees or the perks we used to get or not get. It's about disclosure. And it's the same issue I have with CNBC when they put Gordon Johnson on to say that Tesla is worth $20 a share when we all know that it's a joke. It's a joke. It's like Dave Portnoy, you know? And I'm like, dude, this guy's like, where's the disclosure? Does Gordon Johnson get paid by somebody to talk bad about Tesla? Because he should have to disclose that, but he's not a real investment firm. And so most of the people on financial television don't actually work at real investment firms because the real investment firms won't let them on CNBC. But then they all have these conflicts that aren't forced to be disclosed. So when you're watching financial news, a lot of the guests are being paid, and I know some for a fact, which I will not tell you, but I know some for a fact are on the payrolls of companies they recommend while they're on CNBC or whatever channels they're on. So disclosures is the issue. Guys like me, I got to disclose my whole life, you know?
So you're saying that's different from somebody like, you know, Dr. Scott Gottlieb. He's on CNBC all the freaking time, but he discloses that he's on the board of Pfizer. Is that better then?
Correct. Yeah. I want to know that he's on the board of Pfizer. That means Pfizer pays him $700,000 a year to say, you think he's going to go up and be like, Pfizer sucks?
Right. Of course not.
No.
So
it's like, it's fine. Just disclose it. I'm fine. Dr. Gottlieb, tell us about Merck. Oh, Merck sucks. Oh, what a surprise.
Gotcha. Okay. Got it. So
it's the same. I own Tesla. I'm biased to Tesla. You know what I mean? It's like I disclose it. I own Tesla. I own Apple. Everything I talk about, I'm biased to. And you should not think anything otherwise. You know?
Okay. Although you did just say Apple has stopped innovating. You still
but I still own it. Yeah, I'm going to hold it forever. Yeah. I told you. What it's like I never sell. It's just not going to sell it.
Okay. All right.
My cost base is like $30. Like, why would I pay taxes for no reason?
I like that. That resonates. What about genomics? So this is so complicated. I feel like you need biologists to help you make sure you're not throwing a dart here blindly, which in genomics kind of feels like you're just waiting for some trials to come in and go, yep, people don't die, people don't get cancer. You know, how do you play this?
I think you hit it on the head. You're throwing darts, my man. It's, you know, this is any biotech forever has been a throwing dart, you know, investment strategy. So we play it through indexes. You know, I would rather throw 20 darts than just 2, right? So we throw a lot of darts in that area, but like the potential is huge. And I think I'm even more bullish now after seeing what mRNA has done for coronavirus and the fact that we've been able to innovate through this incredible technology, a cure for one of the most.
Uh-oh. Looks like we finally lost him. I'm sure Ross will be right back. We'll give him a moment here. But I love the idea of never sell, and it'll be exciting to hear what he says about Moderna and some of the other genomics. But I think y'all know, like, oh my gosh, the never sell thing is so awesome. Let me just quickly message him here. And I'll get you back in. Okay, perfect. So yeah, I mean, I love the idea of never sell, and I think he's right on. I think it's really fascinating that as advisors, they at his company, and I want him to clarify this too, will invest in different index funds, and I love the idea that he also basically invests in ARK funds as part of the company's portfolio, right? So it's almost kind of like, hey, I'm Ross. We're going to put, like he says, your pizza together, and we'll use some ARK as a topping. And I guess in some sense, it makes sense that when ARK Invest has these crazy swings in price, a lot of people paper hand and they sell out, right? And this is what we pulled up when we pulled up the inflows and outflows at ARK. Makes sense why, if you're an investment advisor and you're recommending, hey, like the goal here is just to be in. It's to be in the market in a diversified way. I mean, what a great way to do it. If you have I'm going to ask him, does he invest in ARKG? What does he think about ARKG? How is, for example, another question I have is, how is what they do different from like a robo-advisor, right? In some sense, a robo-advisor will just say like, okay, what's your risk appetite? Okay, cool. Here are 10 index funds for you. Here's your S&P 500, and here have a little bit of this, that, or whatever. So I think that'll be an interesting question. We'll ask him as soon as we see Ross. Oh, Ross is returning. It's the return of Ross. He's back. What's up, my friend?
It's like the Russians come in and turn off your computer and when they get tired of you or something. Sorry about that.
They've been on you all session.
Yeah. I didn't go into my feelings about the Russians. And then the computer always goes down, It's like you start talking about the Chinese or the Russians, like everything goes down immediately. Especially when I do.
Don't worry about it.
Sorry.
We were just talking about genomics.
So I said,
ARKG?
So yeah, ARKG is a good play. Once again, it's topping, so you gotta, you're gonna bounce around in that thing. But like ARKG is a good way to play it. I like a little bit different area than ARKG is in, because I really am positive on like less extreme uses of the technology. Like CRISPR is an extreme use of the technology, and I think is going to be a harder thing to accomplish versus genomic data, where a company like Twist, where they're gathering this data, and what is the potential of using this data to really solve illnesses, and then things like mRNA technology, so like Moderna and BioNTech. But here are all these companies that, with the use of technology and genetics together, and what can we accomplish? And I think it's just huge. And we've seen that now with Moderna and BioNTech solving corona, and they'll solve the variants too. That's why I'm so bullish right now, because even if the variants become a problem, I believe mRNA will work, and the vaccine works, and it works amazing. Like the way the vaccine works is such an amazing technology. Like I think it's going to work way better than what people think even. And so,
wow.
So I think you need to be an investor here. And we think that because of corona, it's like the 9/11 for healthcare. So there's going to be so many billions and billions of dollars spent on not only biotech, but improving our health system. Our system is so shoddy and was unable to care for our country in this kind of situation. And we lost a lot more people than we would have if we were better prepared. So we expect a ton of money to be spent on healthcare and the aging population. So this is a major theme for us, whether it's the higher tech area of it or the lower tech area of it, like testing. I bought into this company called Fulgent Genetics that's been doing coronavirus testing, but it's also genetic testing. And this company has gone like up a ton, and I still like this company, and I still think it's cheap. And so I just added to it again. Earnings are exploding in this company because the coronavirus testing and variant issue is going to be extremely complicated and difficult, and testing is going to be a part of our society for a long time to come. So very bullish in many areas here. And I think investors should have a good chunk of their portfolio invested in healthcare and biotech.
Nice. Okay. And now if somebody, like, another thing that I was wondering is, if you're building this pizza and you're putting these toppings on, like some genomics, some innovation, whether those are indices or whatever, what's the difference between kind of what you do and like a robo-advisor? Is it kind of similar?
Good question.
They also, yeah.
It's similar, but like one would be like the Play School version of it, or like the big block Lego version of it, and the other would be like the really complicated like pieces. So like a robo-advisor in theory is a great idea because it gets people to save money. So like It's more like a 401k vehicle to me, but it's also a recipe for mediocre returns because they use broad indexes to build portfolios for people. And when you put, let's say, 4 or 5 index funds of broad indexes together, what you end up getting is like every stock in the world. And the problem with owning every stock in the world is that many of them suck. And so like if you own every stock in the world, then you put some bonds in there and then you put some fees in there. What you end up getting is 6 or 8%. And if you actually figure that out in a calculator, you're 28 years old, you want to retire at 65, and you earn 6 or 8%, and you make 150 grand a year, what you will figure out is you cannot retire. So you're not going to make it. So the stock market's averaged 10% a year over the long term. I'm sure there isn't one property you buy that you're expecting to earn a 6 to 8% return over the long term. You're trying to make 10, 15% over the long term, maybe 20. That's how you make money and build wealth. So if I'm going to get higher rates of return, robo-advisors are definitely not the way. I compare it to dating in high school. I'm sure when you were in high school, you did not date every person in your high school. And there's probably a reason why. Okay. Well, you probably realized you don't.
I dated one person, and now I'm married to them. That's it.
The whole time?
Yeah.
You've never dated in your life? You've never been single in your life?
Well,
wow.
Sure, up until I wasn't.
No, because you said you met her in high school. So, like, how much? No offense, but there's only so much you could get in trouble with before high school.
It was just her.
I know you love her very much, and she runs your business for you, so you kind of stuck with her. No, it's a beautiful thing if you find love at a young age, and I don't think there's a right or wrong. I'm not going to tell you, oh, you're crazy, you're dumb. I've seen relationships work, or not work based off every different factor. So, whatever. At least you don't have to do dating apps and all that kind of stuff. But I guess in your case, you would be a perfect example. You're a buy and hold investor, and you're an all-in investor. You met your love, you're all in. You're married, you have kids. That's great. Okay, that's great. But let's say you didn't do that. Would you just date everybody to see which woman you might have been right with, or would you have set some criteria? Like, I don't like women who are super tall, just not my thing, or I don't like women that, have, their nails are too long. Like everybody has these preferences. So like if you don't have preferences, that's kind of crazy. And then you can like narrow down the group. So that's my thing about robo-advisors is like nobody's using any like intellectual thought process to say that oil is probably not a great industry over the long term. And if I buy the S&P 500, I'm stuck with 6-7% in oil. So could I buy the S&P 450 maybe? Because I don't really want oil, And now that I'm thinking about it, I don't really want railroads that bad either. So can I buy the S&P 400 now? And as you narrow that down, you find that there's probably only 50 companies that you like, and that's what you should own.
Well, so I mean, can you do that at your company? Can you just like if somebody went to you and said, I just want these 50 and I want you to manage the allocations?
Yeah.
Oh, okay.
I mean, people go, like I want to buy 50. Well, we probably buy less stocks, but because we'll throw some of the sector ETFs. So the sector ETFs work great for diversification. That's where ARK comes in. So like we own ARK F because it owns all these fintech names. I'm not going to buy them individually. Square's too expensive to buy individually, but I want exposure to fintech. So maybe I own Tesla stock, Disney stock, Microsoft, Activision, MGM, Nvidia, Tencent, and Home Depot. Let's say that's my top, 10 or so. And then I want fintech. So I'll buy ARKF. And I want lithium, so I buy LIT. And I want cannabis for sure, so I buy MSOS. So by having these now slices of my pizza, giving me the sectors. So most sector ETFs are highly concentrated in like 10 stocks. So a sector ETF is kind of like buying 10 stocks in one versus one. So like if I want to buy biotech, I can just buy 10. And I'll buy a biotech ETF and I get 10. You know what I'm saying? And so like when you're building a portfolio, like let's say your portfolio, you're heavily weighted in Tesla, and let's say you're heavily weighted in Apple. So you have all tech. So you got to look and say, where can I make money that isn't tech? So like you're like, oh, I like this area, and you can buy like cannabis is a nice offset to tech. I can buy cannabis. I can just buy all the great cannabis companies with one shot here, or I can try to buy 4, 5, 6 different positions. And now I got to follow them all. So that's the big challenge of my life. I can only follow so many companies, and so I follow like 20 to 25 closely. And after that, there just isn't time. And so,
yeah, and then you go into ETFs and that.
Yeah, so like I would rather use an active manager who's an expert. Like I want to invest in China, and it's not my thing, so I'll use an active mutual fund with a great manager and pay for that. Maybe it's 75 basis points, or I use an ETF. I'll pay 75 basis points for a sector ETF, like we're into bots, robotics, or I buy bets. BETZ, which is for online gambling, which is like a great sector. You get Paying Gaming, you get MGM, you get Paddy Power, FanDuel. So like if I want to just be in online gambling, I can like do all the research, follow all these companies, or I can just buy the ETF in the sector, and I've got the exposure, and I don't have to waste my time.
And now that fee is charged, I imagine, on top of your management fees.
That's right. So we try to limit that. So like that's the challenge is like, okay, we're trying to limit fees for people. So you might have a portfolio that's, depending on how much money you have with us, it might be as high as 50, 60, 70% ETFs and then 30, 40% stocks. Or the more money you have with us, it will be mostly stocks and individual issue bonds and things like that. So we can really keep our fees low. And we try to choose the lowest cost ETFs that we can. But any of the good sector ETFs are 75 basis points, and they have to provide that value or it's not worth it to us.
That makes a lot of sense. Okay. So, that makes sense. Now, what about, I'm trying to think here. Like, I guess the way you set it up makes it so that people have less of those heart attacks is kind of your goal, right? Because earlier you mentioned, like, if you go heavy on certain things, you have a heart attack, then you end up selling many times because you're panicking. Right. By having this nice balanced pie, it's a delicious pie, but you're not worried about all these heart attacks, right?
Right. So like if you're going to get to the train station, let's say anyways, like not having the bumpy ride helps people get to the train station better. So you have to offset the bumpiness of the ride with the likelihood the passenger gets off the train. You know what I mean? And so if they get off the train because they panic and they sell, then you failed as a financial advisor. So in the financial crisis, I had one client who forced me to sell at the low. It was a horrible decision. And I fought. He wasn't my client anymore because I fought with him. And I was like, dude, this is not like I was yelling at him. And he's like, sell all my stocks. I don't care. I don't care what you say. And he was a lawyer. I was like, I'm going to get sued if I don't do it. So I did it. And I you document it. And he was like the one guy who sold everything. And then, of course, the market comes back and he moves his account. And that was one of the few clients in my career I've lost. And when the market comes back, you just like, man, you just are like, oh, it sucks. Like, it's so painful that this guy, in this case, probably lost 600,000-700,000 of his money that he would have just made back, but he just couldn't handle it. And it was like he was getting divorced. That was part of the problem. And so he was going through a tough emotional time. And then he had this new girlfriend, and the new girlfriend knew everything. And I was like, sometimes when you're getting divorced, it's not a great idea to listen to your new girlfriend, you know? Like, I've been with you for a long time, my man. She's been with you for 6 weeks, you know? And it's like, you're getting emotional. But,
Wow.
that, so like, I think that's one of the most important things you do is what we call stress testing your portfolio. Do you stress test your portfolio? Like, if the market goes down, let's say rates go up and the market goes, like, I think there's a realistic chance that we could see a 20% decline in the S&P. Okay. And that would get us back to the valuation that's normal for the stock market. Okay. So if we were properly valued, it would be a 20% decline in the S&P, and then you could buy the heck out of the stock market. But if you knew that was going to happen, that means Tesla's going to go down 30 to 40%. It means Nvidia is going to go down 30 or 40%. Activision, all my tech stocks are going to have more than one beta. That means they go down more. Okay. And then what are the things that don't go down in that environment? And unfortunately, there's very few. There's government securities and there's gold. And that is it, because Bitcoin's going to go down when the market goes down too. It is not a hedge against the stock market. And so you've got cash, you've got gold, and you've got government securities. They're the only things that don't go down. So I'm sure most of your listeners today have none of those three things. Okay. So they have portfolios that are 100% levered to risk.
Yeah. Are you then evaluating your portfolio just by beta weighting? So you have it balanced out, or how are you balancing it?
Well, our beta's high. The Tesla hurts your betas. So we correlate closer to the NASDAQ on the equity side, and then we offset that by our balance. Right now, we're holding about 25% in bonds, and those are in mostly municipal securities because they're tax-free. And that creates a little bit of an anchor. And then these offsetting positions, like the boring stocks that I own, are now 5 to 10% allocation. Then we have about a 10% allocation to real estate type investments, which usually hold up a little bit better than stocks, so that offsets some of the down. But the way I'm positioned now in a down market, I'm going to probably, during the 35% decline last year, we were in a more conservative position, and I was down 20 at the low. So I was really happy being down 20, because that kept me in the game, and we were able to really have a great year last year. As I was saying, you become a legend when you can buy when everybody's selling, not buying when everybody's buying.
Can you go into leverage if you wanted to temporarily if you are at a bottom like that? Yeah. Okay.
We have margin and we have options and we trade them, but like, look at it this way. Last year was our greatest year in a long time. Let's say my average client made over 30% with 40% of their money in bonds. Okay. And we have proof of this, and we can show it. It was incredible. It was Tesla and it was tech, but we're big video game investors. Everything worked last year. Okay. Part of it was luck. Everything worked last year. Doesn't always work out that way. And, but like, if I can make 30% and 40% bonds, like, I consider that's like my masterwork. You know what I mean? So like, if you look at the equity section of our portfolio, a lot of it was up 100% last year, like, so if I was just all equities, I would have made 60 to 100% last year. Like, but because I was so conservative, because it kept me in the game when shit went bad, I wasn't down 35%, and that keeps my clients in the game. And so, as I said, my only mistake was not really seeing how the Fed backstop was going to create this market rally as good as it was. And I held that 40% through all last year. I still, up until even November, was pretty bearish, like, my experiences every time has been, you have this low and you think you're done, and then you get killed again worse. So like, my instincts were just to stay conservative. And since we were making money, it was okay. So if I say to my client, if I wasn't so conservative, you would have made 80% last year, but because of my stupidity of, being conservative, you made 40%. Well, the S&P was up 10, like, what are you going to do? Fire me? Now clients are super happy, and they were super happy to avoid the 35% on the down and to make a good solid return on the up. It was my best year I think it was my best year ever, on a risk reward basis, and also having a bear market and a bull market in the same year, which is pretty rare.
Because you can't actually lock people in. Like when the market's
No.
down 35%. Yeah, okay.
It's their money.
So,
they can say, if they say sell it, I don't give a shit what you say. I have to sell it.
Gotcha.
That's the way it works.
I wonder
if my money.
When's there going to be like a Ross Gerber or Gerber Kawasaki app where people are just like recurring investing through the app and just it goes into your fund? Like, couldn't you do that? Wouldn't that be easy?
Now you're getting into the complicated part. So the broker dealers should have built this, but they can't. So they're just trying to build apps that people can check their accounts. Now we have an app. It's called mymoneypage.com. My Money Page, and you can get it on mymoneypage.com. You can download it on the Apple Store. And it's really just to aggregate your accounts. You can follow along. You can build your financial plan. You can look at your stocks or whatever. But it's really because people like to look at their accounts. And people have accounts all over. So we created this app, and it's great. But you can't buy or sell anything through it, or you can't add money through it. So that's the part that's really troubling, because when Robinhood started and Webull and all these apps, people could sign up and just invest money without having to fill out the kind of forms that we're required to do. So I was always confused how they could do this. So what it turns out is they're not actually gathering the legal required amount of information from their clients for Know Your Client and AML. So firms like Robinhood have been recently fined and are severely looked at by the SEC, and they're going to be severely looked at by the SEC for suitability, because they really just don't know anything about their clients in the way that they're doing this. And that's actually illegal. So that's part of the problem. There's two sets of rules being followed right here. The set of rules that my industry is working under, and then a set of rules that the online industry is working under, which includes really just letting anybody trade on margin and options, not checking suitability, not checking Know Your Client, not checking whether the money is legal or illegal. They know nothing about their clients. They have 13 million of them. It's totally illegal. And the SEC just doesn't have the resources to do what they need to do, which is go through all 13 million accounts and say, is this suitable? What's going on in this account? And what would happen would be about half of them would be shut, because they just don't have the client data or information about the client, or whether this is suitable, whether they should or shouldn't be doing stuff. So that's what makes it hard for us. But we are going to launch an ETF. So the solution was launching an ETF where somebody could just invest with our firm and not have to open an account and move their money and like have us be their financial advisor. Not everybody wants all those things. And so some people want to just go on their Robinhood and buy Gerber Kawasaki, and that's what we're doing. So we're going to launch an ETF. It's looking, I won't be able to talk about it once the paperwork's filed. It's probably next week, and then in 3 or 4 months we'll be launching. And so anybody in the world can just buy the ETF.
Easy, and that's great. I mean,
and so we're selling toppings. So I'm going to sell the toppings. And if you want the pizza, you come to my firm, and if you want the toppings, you can buy the ETF.
But if you buy this, if you have this ETF, isn't it going to make you like impossible to talk about this publicly without going through all the approval processes that your advertising got covered? And like, isn't that a big pain in your butt now if you do an ETF? Like that sounds like it's going to get 10x worse. The advertising part.
Thanks for talking me out of it, Kevin. What you're saying is true.
Yeah, I feel it's like you're so vocal.
Let me explain to you how it works.
You're so vocal.
Let me explain to you how it's going to work. It's not my ETF. I'm doing this through a company called Advisor Shares, and they are an ETF company, and they asked me to be the sub-advisor of their ETF. So the way it's going to work is if I'm talking about my ETF, I have to follow all these rules. Okay. But if I'm just talking about like what we're talking about now, is like, as long as I don't say like buy the ETF, the symbol's GK or whatever, which I just did, I guess you're not supposed to do that. The rules are so arbitrary. And I've been fighting the FINRA rules up until 3 years ago when I left FINRA. And now I have to go back and have to fight them again. They're so arbitrary. So the way I look at it is, I don't know. I have lawyers.
Because here's just a thing that I've heard is that if you have an ETF and let's say your top holding is Tesla in the
Right.
ETF, right? But then you're on Twitter going Ford's effing bullcrap, buy Tesla. In some sense, like because of the regulation in our country is so stupid, in my opinion, it's way overly done, the regulation. You should be able to say whatever the F you want. But because you're a registered investment advisor, now that could be deemed a conflict of interest. Like that sounds like a headache, man.
No,
like
no,
if
no.
you figure that out.
It's the same headache.
Okay.
The disclosures of positions aren't an issue if you disclosed your positions, So like,
Okay.
so the issue would be more like if I'm talking about Tesla and I don't tell you I own it, it's like, it's like, oh, you're not being fair. As long as people understand where you're coming from, that's legal. Where the rules are convoluted is like talking about the ETF itself. Like just me saying the word ETF creates a whole layer of regulatory questions, But here's the thing, and this is what I've learned dealing with the SEC. They care about investors, okay? So we care about the same people, okay? So like I care about my investors, they care about my investors. What do they care about? They care that the investors are dealt with fairly and things are honest and you charge a reasonable fee, things like that. Things that I think are reasonable. If I'm promoting my ETF, I have to put on an ETF hat and I'll have to have things approved. Like press release will have to be approved and legal has to look at these things. But if I'm in a financial advisor RIA hat, I can continue to do exactly what I'm doing. And so really what it is that I won't be able to just like freely just promote the ETF, so for example, this is a live appearance. I can talk about it. You asked me a question and it wasn't planned. So this is legal. This is legal. But if it was planned, it would have to have all these disclosures and have to be pre-approved and there'd have to be a script. So these are the rules. They don't make a lot of sense, some of them. So like if you do live television, it's fine. But if you're doing something that's not live, then you have 100 rules you have to go through. So it's like,
how's this going to be different from Portnoy's Buzz ETF? Because I think his is just like index space, right? It just follows some sentiment tracker.
Well, Portnoy is just a paid marketer from Van Eck, so like he doesn't manage money, it's like if I paid you and I said, hey, Kevin, help promote my ETF. And you'd say, oh, it's Kevin's new ETF with Ross. And I just paid you a fee. Well, it's not really yours because you can't really be involved with the investment process. So it's like, you can pay people to promote your ETF. Like, I think the Q's is the sponsor of March Madness. I think actually the Q's ETF is the sponsor for March Madness on CBS right now. And I think it's the weirdest promotion I've ever seen. I was like, why would anybody watching basketball care about the Q's ETF? Like, I don't even think people know what that is, And it's like, whatever, they just dropped like 20 mil. And so you can advertise if you're an ETF. You can do these things, and that's what Buzz is. Buzz has an algorithm. It's a 75 stock algorithm. It rebalances monthly, and it's based off Twitter sentiment and other sentiment indexes, which is really tracking people like me. So like people like me, when I talk about stocks, then they track who else talks about these stocks. And the more mentions and positive mentions, the algorithm then ranks the stock higher. Now, it's like a sentiment index. There's been this concept for a long time. If you look at the portfolio, it's a decent portfolio. It's 75 stocks. It's too many stocks. It rebalances monthly. And I looked at the first monthly rebalance the other day, and it was like really arbitrary. Like they traded out of some bad stocks and good stocks and bought in some bad stocks and good stocks. And I was like, so it's arbitrary. It's almost like 75 arbitrary stocks, but they're not all bad stocks. There's good stocks in there too, but it's like 75 arbitrary stocks. That's the portfolio.
Gotcha. Okay, so yours is gonna be different. I imagine more concentrated or something.
No, it's multi-thematic. So we invest around themes like climate change, video games, online gambling, cannabis, pet businesses, technology. What else are some of our themes? That's most of them. No. No money in space.
Wait,
Such a
wait.
joke.
Kathy's about to start what the Arc X or whatever for space.
Money, baby. Kathy's printing money. You know how much money? Kathy's like a billionaire now. I want to be like Kathy. I'm going to start a space ETF. I'm going to start a moon ETF. I'm going to start any ETF any schmuck will buy. You know, I mean,
no. Well, but
how are you going to make money in space? You know how space works? You see how many starships they've crashed? How many starships do they crash before they get this thing off the ground? You don't make money in space. Yeah. Okay. The purpose of space is exploration. It's for the good of man. So countries have invested in space programs to achieve things, not to make money. That's not the purpose. Starlink maybe makes money. Okay, that's a good business. It's a satellite internet connectivity business. I like that. Yeah. Starlink, okay, profitable venture.
Okay,
taking people back and forth to the space
ETF. They're like, or that kind of stuff would be.
Northrop's a good company. I like Northrop. They have a space program, but they're a military company. But the idea that I'm going to start a business like SPCE, and I'm going to take people to the edge of the atmosphere on a tourist trip to space and back is the most farcical company in the stock market. Like, to think that anybody's going to get on a plane that's going to hit the end of the atmosphere for 200,000 or something for a 5-minute flight or something, so you can be like, oh, I feel weird, and then you come down, when you can buy a VR thing from Oculus for a couple $100 and actually go to space. You know, if you smoke some weed and you use a VR thing, you can do crazy things in space already. Okay? But it makes no sense. Like, who's going to risk their life for a flight for, you know, like, they can't get this thing off the ground, let alone into space, you know? You going to get on it? You got 2 kids, right?
Nope.
1 kid?
Yeah.
2 kids?
2.
Yeah. You have 2 kids. Oh, honey.
I got 5 to go, man.
5 more kids? You got to put a kid in every house? What do you have 20 houses?
You got to have an ETF for kids.
A kid for every house. Listen, that is a bad financial planning mistake. I'm just telling you that. Okay? Even the richest of the rich go broke with 5 kids. Even the richest. 5 kids
7 total.
You want 7 total. So 7 in private school is $450,000 a year. Okay, and that's post-tax. So you'll have to make $1 million a year just for education in, like, I don't know, 10 years. So when you're 38, you'll make it. You'll make it. You'll be so popular.
Have an ETF like you.
Yeah, you can help me. You can be like my Portnoy. So where do you live exactly? What state are you in?
I'm just above you, Ventura, California.
Oh, you're in California. Oh, so you're going to pay California taxes with 7 kids? Come on. You need a financial advisor, buddy. We got to talk. I'll talk to your wife. Listen, she'll be tired. She'll be so tired after 3. This must be your idea. Is it your idea?
Yeah.
It is your idea. You haven't talked to your wife about this, have you? Seriously, Kevin, I'm being serious. I do this for a living. Have you talked to your wife about this idea?
It's growing on her.
My wife is done, man. I'm like, we're on the same page. It's growing on her. Listen, three is usually what pushes people over the edge. Okay. Now, see, the good news for you is you've never known another life. You've never known another life. You don't know the other life. And that's fine. You're better off that way.
Okay. Wow. Well,
why do you want to have 7 kids? Why do you want to have 7 kids?
I love kids.
I do too. I love kids.
I want an army so we can have our own compound of little business people and we can go trade stocks together.
I got my one kid. He's doing YouTube videos. He's doing websites and all this crap. And I'm like, dude, you got to slow down. You're 8 years old already trying to build a business empire, you know? And It's great. My other kid doesn't care at all. You know, he's like, I just want to chill. It's if you have 7 kids, you're gonna get one of every stripe. You know, you'll have some kid who wants to go in the army, and the other kid wants to, you know, paint. Who knows? Who knows?
Wow. Well, hey man, this has been amazing. We're at 2 hours, so I gotta ask you, man, any final thoughts you have? And thank you.
I don't get to ask you questions today. No,
ask.
You know,
what do you got?
Well, no, because I watched a couple of your videos, and so you basically run your business like, so you have your YouTube channel, and then you've got your real estate business, and your wife helps you with that, and you manage all your properties, and then you've got the stock portfolio, right? And so like your interest in stocks really grew as you took that money out a year ago and you started investing in the stock market, and so you've really been, you know, learning and building your portfolio, and you've done very well with it, right? And so like you kind of have this balance of like 50% real estate, 50% stocks. Is that about right?
That's correct.
Because I like that. I like that approach, you know, because see, I always tell people about real estate. Like, I don't like real estate because I don't like having to do stuff like on the weekend where it's like, oh, something broke or this or that. And you have your wife do that. So like, you know, that's fine. But I like the idea of that balance, because one of the things I try to teach people in investing that I learned from real estate people is the value of cash flow. See, a lot of investors only invest for capital gain, like they only own Tesla, and they don't understand that you can invest for cash flow too. So a lot of our portfolios produce cash, and there's a reason for that, for the same reasons that you have real estate. And I found the way that you manage money, I didn't know if that was really like a philosophy of yours, like I'm trying to be 50-50, or it was an accident just because of the way that your assets worked out and the appreciation of your Tesla or whatever. But I like that because you've got a business that you love that generates cash flow, and you can continually reinvest. And then you've got the stock portfolio. And if you manage it right and you put, let's say, a little chunk in these muni bonds, because you're in California, so muni bonds can earn 3.73 tax free, you know, like that's a good return, like 8% or something for a guy like you. And like, and then you get your dividend stocks, and then you have your higher level of growth stocks. And like that to me is a really smart way to manage your money. The only thing I saw, if that's your strategy, was your leverage risk on your equities and on your real estate, because you own like 20 homes that are similar. And the advantage to that is you know exactly what you're doing. That's what smart real estate people do, is they stick to what they know. Okay. When you get into some big property that's like not your thing, that's when you get killed. Okay. So like, you know what you're good at. And I saw this video, you're talking about this, and you're so right about, you know what you're good at. You know what you want to put in a house. You don't want to listen to some lady tell you what should go in the house. You know what's going to work or not work. You fix these houses. You're a great landlord, which is, boy, that's worth a lot. Just that, you know, because my landlord sucks. And I was showing my wife this thing you were saying about shitty landlords that don't realize they have to work on a property. So I like that business. Then you've got your YouTube business, and then you've got your stocks. And if you lower your leverage because of your age, and you put a little layer of safety on your equity side too, like, and then you say, okay, maybe your net worth is, I don't know, 20 million or so, or 30 million, like, and then you compound that. Okay. Because time is the most powerful thing. So that's how I want to leave this. I think that's why I like you a lot, because you have this curiosity, you're doing a lot of smart things, but you're also practicing what you preach, and you apply it to yourself, but you're teaching independence. You're not teaching people to be dependent. You're teaching financial independence through your own sweat equity, but also investment, you know, acumen too. But I think if you do that, you could be one of the richest people in America in 25 years, because I'm 50. So if you think about, you're going to be the same when you're 50 as you are today. Okay. Like, the only difference between me at 28 and 50 is experience. Okay. And that has a lot of value, but like, I'm just as fun as I was at 28, you know, like I'm probably more fun, to be honest. So like, imagine extrapolating out 20 years from now of compounding. Okay. Even though you might lose a little return getting rid of the leverage, you'll thank me to death at some point in the next 5 years. You'll be like, that Ross guy, thank God I had him on the show. Because that time,
I love it.
the thing whacked me. the thing that whacked me. See, this is what happened to me in the financial crisis. I thought I had every base covered. And then AIG went down. And then it was like everything. Then my house caught on fire, dude. My house caught on fire in December 08. Okay. Just bought $2 million house on the beach. And the fucking thing catches fire, you know? And I was like, I'm done. I'm fucking done. I didn't factor that in. And the fireman saved my house. I met my wife that week. It was the worst week of my life. Everything was gone. Everything. So I started over.
That was the best week of your life. You met your wife.
No, it was not. The best week of my life was maybe last week. You know what I mean? It's gotten better since the day we met. You know, she was the greatest investment I've made. No, I was lucky that week. That for sure. That was the luck. No, so that's what I wanted to express to you, that sometimes things happen that are well out of the lexicon of what is possible. The black swan. And if you cut your leverage and this is your philosophy, you might give up a little bit on return over the next 20 years, but you don't need to take the risk. Your plan will work stupendously. I love it. I love it. And what you're telling people to do is great because it works. I've been doing this my whole life. I started at 23. I've helped so many people exactly what you're trying to do. I've done it as a business and it works. So over 20 or 25 years, you can develop enormous wealth using the techniques that you're teaching people, whether it be buying real estate, buying stock, investing in yourself, starting your own businesses, controlling your future destiny. I think it's great advice. Thanks for having me on, Kevin.
Yeah, thank you for that. I want to give you just a brief clarity there because you asked. So my view in terms of did I engineer this 50-50 real estate stocks, it mostly came from being, I started stocks, and Apple stock helped me buy my first house. But just real quick catch up. I've always thrown money into stocks. But my belief has always been if your net worth is under $1 million, get into some fixer upper 3.5% down, build your net worth fast with real estate because you're getting that leveraged appreciation. And now that can be a scary word, right?
But that's the first million. That's the first million.
Yes. So now it makes less sense for me to go, I'm going to buy this house because my net worth is going to go up 75 grand. Like the way I looked at it in last year, for example, I bought 11 properties last year because I'm looking at these properties like, I buy that. That's 100 grand. That's 100 grand. That's 100 grand. Net worth. It's just like, let me get these because I'm buying them so cheap under market value. Like that's great. But now, when I look at my portfolio, there are times I look, I go, I'm only going to get 70K net worth on that one. Right. This is like super unrelatable, right? It's super unrelatable and I get it. But some of them I look at like, I'm only going to get 70K net worth on that. I'd rather just swipe up on Robinhood on some Tesla stock right now because the numbers have gotten to this point where like, look, if Tesla moves 7%, just my Tesla shares, there's my 70K. I'm sorry. No, that's not 70K. There's 700 grand.
That's right.
7% is 700 grand.
Well, that's why I like the stock market.
But look, had I thrown all my money into a beautifully crafted, S&P 500 pizza with 9 grand, I would have made a lot of money. But I wouldn't have gotten the return I did on like my first house, for example. And that's why I'd like one of the things I've loved is so taking that first $9,000, $10,000, $20,000, throwing it in real estate, building wealth. Then once I have that wealth, then let me get more of those stocks, right? That's just been sort of my psychology.
Right. Well, and I think that psychology works if you want to be in the real estate business. And that's why I think it works for you. You didn't take 9 grand and just put it in a house. You took 9 grand and started a real estate business because that's what it is. Because when I bought that house, when I put that money down, I'm investing my sweat equity. I'm getting a renter. I'm building equity this way. I'm using leverage. So you're absolutely right. Yes. But you're building a real estate business. And that's why so many people have built wealth in real estate, because exactly what you're saying, with a small amount of money and a lot of work, you can build a great business in real estate. And I work with some of these guys who've been doing it now. They're like 80, And then one of my wealthiest clients he's second generation. His dad did it till 90. Now he's running this massive real estate business. So you can imagine the compounding of this continual buy and hold philosophy, lower leverage, reinvest into new properties. And it was the same thing. They started with one property, it was like 1950 in LA, and I think it's a great way to build wealth if you put in the work. And I would say that about any small business too. Taking 10 grand, starting an online store, getting into your business. It doesn't have to be real estate. It can be, technology, or it can be even selling a regular product, but using technology to leverage your business. I think entrepreneurialism in this country is one of the most important things that we continue to promote, because of the socialist strain that's tainting this country right now, and tainting the younger generation into becoming, basically wanting a dependency as a way of survival from the government, which will never happen. It will never happen, and it's a fantasy that will never happen. So teaching people to be entrepreneurial is the answer, because capitalism is the answer. And I can't even imagine how many people you employ, and how many contractors you employ, and how many jobs you've created through this entrepreneurialism. And that's how we solve the economy. That's how we get jobs back. It's entrepreneurialism. And so that's another great thing I think about what you're doing, whether it be real estate or any other business. Take 10 grand, save it up, start a business.
I like that. That's freaking awesome. Well, thank you. This has been a blast.
Thank you.
I think
Thanks
next time we're going to have to go deep on, we need to do like a capitalism political one where we talk about that, because you've got very very strong arguments on both, but I know we could talk for another 2 on that.
I know.
I love the idea of what you just said about getting people educated. I think that's a big thing right there. But thank you. How do people get you to bake them a pizza? How do they invest with you?
Well, it's to send us a message at gerberkawasaki.com. You can send us the email info@gerberkawasaki.com. We're on the internet. We have no minimums, so we work with all types of people, and it's the same idea. Getting started is the hardest part. Saving that first 50,000 is the hardest part. But once you get compounding working for you, exactly what Kevin's saying, you have 700 grand, you make 10%, that's 70 grand now. When you have $7,000, it's $700. So the same 10% compounding over time really, really makes a huge difference. So you got to get started now. That's what we do, is we help people invest, whether you have a small amount of money or a large amount of money. So reach out. It's the secret. Just get started. Time is your friend.
I love it, man. Well, I look forward to seeing your ETF come out as well. I hope Tesla's #1 in that thing. It better be.
For sure.
Otherwise,
for sure.
I'm going to have to.
No,
okay,
for sure. It's my top holding. Yeah.
Good. Awesome, man. Thank you so much. Stand by for one moment. Everybody else, thank you so much for watching. Consider sharing, liking, subscribing. Check out Gerber Kawasaki. Follow him on Twitter as well. Sometimes I'm going to start leaving you some more troll comments just to poke you.
Yeah, I know.
Hopefully you don't ban me or block me.
Come on.
But thank you, everyone. We'll see you next time. Bye.